Good afternoon, and thank you for joining us for today's webinar, Pass-Through Entity Tax, a new frontier in state taxation, presented by PBMares, a top 100 CPA and business consulting firm, as noted by Accounting Today and Inside Public Accounting. My name is Susan Miller, and I will be facilitating and moderating today's event. Before we get started, there are a few housekeeping items to cover. Today's webcast is being recorded, and you will receive a link to it along with the slides and a follow-up email. If you have any questions during today's presentation, you may enter them into the questions box on your screen, and we will attempt to answer as many as we can during the webinar. If we do not get to your question, a member of our team will follow up with you after the webcast. If you have any technical difficulties during this live webcast, you can refer to the recording or reach out to our team with any specific questions you may have. Our panel today is composed of members of the PBMares state and local tax team. You can find their bios in the handout section of your screen. Our first panelist today is Lori Roberts, leader of the firm's state and local tax team. Take it away, Lori. Lori, you're on mute.
Thank you, Susan, and thank you for reminding me to be off mute. We have some exciting stuff for you today, but we want to launch this with a poll. So Kim has our poll for us. And Kim, if you could read, oh, here we go. Had you heard of pass-through entity tax before learning of this webinar? Please select an answer. And an answer that mostly reflects your situation. And we have just a few seconds, about 30 seconds to vote. All right, do we have some results? Yes, okay, very good. And a few of you had not, or you're not sure if you've heard about it, okay, and it looks like we had at least one soul concerned about the fact that this is a tax webinar, but you are welcome to stay with us, and who knows, you might find something that would be of great benefit to your business or investment. Let's go on to the next slide. PTET has been, next slide. Okay, great. PTET has been a huge topic of conversation with tax professionals, whether it be at a cocktail party, I think we're getting back to those, around the water cooler if we happen to be in the office, but certainly on our chats and emails and what have you. This is a tremendous opportunity for taxpayers, for pass-through entities to achieve some great tax savings for their owners. Now today we're going to focus on our footprint states. Sam Baker, one of our presenters, is going to discuss Maryland. Their PTET has been in place since 2020. John Given is going to discuss North Carolina. They're coming live in 2022, as is Virginia, which I will share with you. We'll also discuss a little bit with other states, but this starts to get really accounting, tax, geeky, nerdy, and I think you'd all be asleep or tearing your hair out, one or the other, if we went into too much detail. I will put out just a little comment. District of Columbia has always had their own franchise tax at the entity level, so this regime really has no impact on that. It is what it is. So let's go to the next slide. And what is this pass-through entity tax, or what we are referring to as PTET? In most cases, except for Connecticut, this is an optional state income tax for pass-through entity taxpayers that avoids the SALT cap at the individual taxpayer level. It's an opportunity for federal tax deduction for state income taxes without limitation, and we'll look at that a little more in our next slide. Okay, and this avoids the SALT cap for the individual filers. Now here again, I'll make a comment. I mentioned for Connecticut, the PTET's mandatory. I've already talked a bit about the DC franchise tax. There are a couple of other states that have their own state entity level taxes. So let's go to the next slide and I'll show you a picture of this. All right, so this picture here, many of you may have looked at your individual returns and seen this big pile of taxes that you've paid, but oops, well, lo and behold, all you can deduct is $10,000. Yuck, nasty, horrible, horrible. But this provision was put into place with the 2017 Tax Cuts and Jobs Act. And this was done in order to offset the impact of some very significant rate reductions for corporate and business taxpayers. So they had to come up with revenues from some other sources, and this was a big one. It created a profound impact on blue states, and I don't want to be political here, but it's reality, due to the combination of higher state and local taxes and high income levels. Red state legislatures feel that to be able to deduct all of these taxes is an unreasonable benefit. So we'll leave politics there, but that's where the arguments were. So immediately, state tax legislators began looking for workarounds to lessen the impact of this SALT cap. And in 2018, Connecticut was the first to implement it, but they did it as a mandatory tax. Next slide. So this slide gives you a very simple picture of what's going on with the PTET. Let's say an entity has taxable income of $22.5 million that it would normally pass through in a K-1. But if it elects into PTET, it's going to enjoy a tax deduction of $143,000. And this is Virginia rates, so hence the 5.75%. And so you can see the income flowing through on the K-1 is going to be significantly less. Now, this will impact the qualified business income deduction that we've been talking about for a couple of years. So hopefully you're familiar with that, but it will adjust that a bit. And so now the adjusted taxable income on the 1040 coming from this entity is going to be reduced because of the benefit of the PTET. So in short, if we've got a taxpayer at the marginal tax rate of 37%, which is where somebody would be if they're pulling in $2.5 million of income from their pass-through entity, they're going to enjoy tax savings of $42,000. Now, isn't that cool beans? Isn't that something to get really excited about? All the things you can do with $42,000? Woohoo! Okay, let's go to the next slide. So, talking about the PTET in general, all right, these provisions are passed at the state level. And this is where I do my, I don't know if it's famous or not, but I make my comment, 50 states plus the District of Columbia, you have potentially 51 sets of rules. However, later adopting states have learned lessons from some of the earlier adopters, so that's good news. So I'm going to turn this over to Sam Baker now, who's going to start discussing Maryland. And I'll say Maryland was thrown off the high dive when this was implemented in 2020. And I swear he went bald wrestling with all these various issues. Sam?
Thank you for the introduction, Lori. That is it is one of the many reasons I went bald. But Maryland at first did cause me a lot of stress. I am not sure if any of you remember or aware, but the rules, calculations, forms changed more than a few times before it finally landed in the final destination where it stands today. And of course, this was all done during tax season. So trying to advise clients in the middle of tax season, giving said clients advice, and then turning around and saying, remember that advice I gave you? Well, Maryland changed it. It makes for a lot of not so fun conversations. But as I mentioned, most of these kinks have all been worked out and it's currently running smoothly, knock on wood. So can we go to the first slide or the next slide? There we go. So the Maryland PTET became effective January 1st, 2020, and entities that have individuals and entities as partners or shareholders all qualify for this election. An entity is able to elect the Maryland PTET by filing Form 511 instead of Form 510. Similar to the non-resident withholding, estimated payments are expected and underpayment penalties will be applied if an entity is underpaid. The tax rate for the tax is 8% on behalf of individuals and 8.25% on behalf of entities. For example, if an LLC had a profit of $1,000 that was allocated to Maryland, and that LLC has 2 individual owners, the Maryland pass-through entity tax would be $80, 8% times 1,000. If that same LLC had 2 entity owners, that tax would be $82.50. Can we go to the next slide? Here we go. And this is more of a side note. When there are multiple tiers of ownership or difficult profit allocations in a partnership, the Maryland PTET allocation can sometimes be at odds with how cash distributions would have been made if there had been no PTET election. In these circumstances, it's a good idea to speak to a tax advisor to help you map out what it will look like. For example, I have a few clients that have tax-exempt entities as investors, such as an IRA or pension, someone invested in a partnership through their IRA. Maryland does not calculate a tax on the income allocated to tax-exempt entities, so the Maryland K-1 will not show any taxes paid on their behalf. However, the entity elected into this tax and gave this benefit to all the other investors. So everyone receives a benefit except for the tax-exempt entities. So me and my team mapped this out ahead of time and explained the issues to the partnership managers, people in charge of the partnership. And they went directly to the operating agreement and see what powers they had. And they realized they had the ability to make special distributions to those tax-exempt entities to make them whole. And this way, the tax entities were made whole, and the other investors were still able to receive the benefit of the SALT cap workaround. It's just important to have these type of discussions ahead of time before any decisions are made, so all partners receive their fair share. The credit for the taxes paid on partners or shareholders' behalf is reflected on the Maryland K-1, as I mentioned. The PTET is refundable on an individual's return. It's important that individuals add back the Maryland entity tax that was paid on their behalf to their Maryland income. For example, let's say an individual receives a K-1 from a partnership, and on the federal K-1, they had ordinary income of $92,000. On the Maryland K-1, it says the entity elected into the Maryland PTET, and $8,000 was paid to Maryland for the PTET tax. And for simplicity's sake, let's just say their federal adjusted gross income was $92,000. On the individual's Maryland return, they will need to add that $8,000 that was paid on their behalf back to their federal AGI of $92,000, bringing their Maryland AGI up to $100,000, which is what their federal AGI would have been had no PTET election had been made. So they received a $8,000 deduction. The Maryland return will show Maryland income of $100,000 with $8,000 paid on their behalf through the PTET. It's important to note also that Maryland non-residents with income allocated to Maryland will need to file a non-resident Maryland return, and everyone that had amounts paid on their behalf will need to attach the Maryland K-1 to their tax return, and this will help avoid notices. Our first year, we received a fair amount of notices because it was not attached in all circumstances. And that's pretty much it for Maryland. And now that Maryland has worked out all their issues, Virginia, as Lori mentioned, decided to try their hand at it. And our very own SALT team leader, Lori Roberts, is going to dive into all the Virginia kinks and issues and, take it away, Lori.
Thank you, Sam. Yes, I agree. Virginia learned a lot from Maryland and other states that were very early adopters. So Virginia's program, Virginia's PTET, I'll go on to the next slide, please. Virginia's PTET goes into effect essentially for 2022, but due to political reasons, there's a provision for it to be retroactive to 2021. But we're going to set that aside because Virginia Tax Department has not provided the instruction to go back and get it. And of course, everybody's filed returns for 2021, but those instructions aren't going to be available until well into 2023. So we'll be filing some kind of a claim or refund or something on that order. Virginia put the restriction in place. Only entities 100% owned by natural individuals are eligible to participate. As soon as we saw natural individuals, of course, probably everybody's thinking, what, a natural blonde? But the idea here is if an entity is owned by individuals and they also include eligible S corporation shareholders, where by and large the income is going directly from an entity to land into an individual or possibly a trust return, then you can elect into PTET. If you have an entity that is owned by even 99 individuals and you've got one pass-through entity or corporation or something in there, then that entire entity is not eligible to participate. So this is creating a lot of discussion in Virginia, a lot of angst. The lowest tier entity that is owned by individuals, when you do have the multi-tiers, they're going to be able to elect into PTET, but they precluded everybody else. So when we get to the end, we'll talk a little bit about some tax planning and strategizing. But entity must be 100% owned by natural individuals. You elect by filing the form upon, the Virginia 502 PTET. It will be a new form coming out, and that is done at the time of filing, the due date of the return or the extended due date of the return. Estimated payments are expected. However, they're not required for 2022. There will be no penalties or anything if you don't make any estimated payments at this point in time or prior, because it is such a new law. But I will say, if you're a cash basis taxpayer and make an estimated payment in 2022, you'll be able to deduct that payment on the entity return as a 2022 expense. So there is benefit to going ahead and making some estimates now. The tax rate across the board, since we're only talking about natural individuals in Virginia, will be 5.75%, which is the highest marginal rate in what most individual Virginia income is taxed at. Let's go to the next slide. Okay. A quirk with Virginia is resident owners are going to be taxed on 100% of their allocated income, regardless of what may be apportioned to Virginia. So this is going to apply for entities that are working or doing business across state lines, multi-state entities, we call them. Virginia resident owners taxed on 100%. And the presumption there is, hey, it's all going to end up in the Virginia tax return anyway. Non-resident owners are only going to be taxed on their income apportioned to Virginia. So we have an interesting conundrum here that effectively the partnership's going to pay tax at more than 100% of its income at the state level. However, that tax is all going to be deductible. So it can actually be a bit of a windfall moving through to the owners, especially as the credits for the PTET or the benefits settle themselves out in the individual returns. So we're finding that to be an interesting paradigm. And yeah, it sounds complicated. It took us to wrap our heads around it, a little bit of time to wrap our heads around it. All right. The allocation is going to be based on the share of income taxed to the pass-through entity, or the owner's share of income that they have in the pass-through entity. And the adjustment, the true-up on the owner's return is going to be a credit against their Virginia tax liability. So it will be, the tax will be calculated, and then the pass-through entity tax will come through as if it were a payment of tax. And the pass-through entity tax will be refundable. The credit will be refundable, unlike a number of other credits on the Virginia return where you are limited to your actual Virginia tax liability. And you may either lose them or they may carry forward to the next year. The PTET will be refundable. Non-resident owners are not required to file a non-resident return. You'll be one and done with just the Virginia entity return. However, we are seeing as we work through specific details with certain clients that it may behoove filing a Virginia non-resident return. So now you have an individual tax return in another state that will enable you to take state tax credit in your home state. So again, this is an example of a complexity that is best discussed with your tax service provider to see where the nuances are and where the benefits are and to help work through the details so you don't leave money on the table. Next slide, please. Along with implementing the PTET, the Virginia legislation that enabled that PTET has also clarified credit for taxes paid to other states. Prior to 2022, Virginia did not allow any kind of, we call it other state credit or credit for taxes paid, if it flows through particularly a partnership. That was not allowed, but Virginia is allowing direct credit on an individual return for taxes paid through another pass-through entity that somebody may own. So let's say the Maryland PTET or the North Carolina PTET, they'll be able to take credit on the Virginia return. It should be noted that other state credit is not allowed for any local or city taxes or any tax identified as franchise tax, which includes the District of Columbia, Philadelphia, what have you. So it's only state level taxes. All right, I'm going to turn this over to John Given, who is going to fill us in on North Carolina provisions. John?
Thank you, Lori. So let's move further south to North Carolina. Next slide, Hannah, please. Thanks. All right, so North Carolina, like Virginia, is effective January 1st, 2022. Though unlike Virginia, we are not retroactive to 2021. We are going to start in 2022 and just move forward. So the business tax returns that you'll be filing in 2023 for 2022, that's when we're going to start. The rules for who is eligible they are a little bit different than both Maryland and Virginia. The shorthand easy way to think about it is that if you are an S corporation or if you are a partnership that could be an S corporation, then you are eligible. That's because that S corporations must be owned by individuals, and that includes the estates of individuals who have died, or certain types of trusts or certain types of exempt organizations. And North Carolina has written their PTET rules to follow exactly the federal S corporation rules. Now, this does present the same problem that Lori described in Virginia, that there are some entities where you will have individual owners, but also a corporation or a partnership as an owner. And that entity is going to be ineligible. So those individuals, if only individuals own the company, then they would be eligible to participate and get the workaround for the federal SALT cap. But because they have a partnership or a corporation next to them as owners of this other company, they're never going to be able to get it. That's going to take some tax planning opportunities and further discussions with tax advisors. All right, to participate in the North Carolina pass-through entity tax is actually quite easy. You are checking a box on your regular North Carolina state return and filing the PTET return with your regular North Carolina business tax return. The tax will be calculated right on there, and the tax will be paid right on there. Estimated taxes are not required, is probably an overstatement here. There's no interest on estimated tax payments that are missed in 2022. Going forward, 2023 and forward, they will be required. But in 2022, if you do miss them, you at least won't be charged interest for missing them. But let me emphasize what Lori also said, that if your business reports its taxes on a cash basis, then you're gonna need to make payments in 2022 to get the deduction on your 2022 tax return. So make sure that you are making payments by December 31st, 2022, in order to get the deduction on the tax return, on the next tax return that you file. And then finally, North Carolina's tax rate for the PTET is 4.9%. That's for 2022. As those of you who are residents of North Carolina like me, as you all know, our individual tax rate is going to be going down over the next 6 years gradually. And so the PTET rate is also going to go down. The PTET rate will simply match the flat tax individual rate in effect each year as the tax goes down. Next slide, please. All right, let's talk about residents versus non-residents and how that impacts the PTET tax. When the company, when the entity calculates how much tax it's going to be paying to the state, it, like Virginia, is going to count 100% of the income for each resident owner. But then for non-resident owners, it's only going to tax income that is apportioned to North Carolina for that non-resident owner. But the math actually comes out a little bit differently from the way that Virginia has done it. So in North Carolina, if you were just filing an individual tax return as a resident, this is how the individual tax return would work. You would report 100% of your income from the business, and then you would file returns in other states for taxes that are owed and income that is earned in those states. When you do your North Carolina return, you then get a credit on your individual return for the taxes paid to the other state. That's how it works without PTET. When PTET goes into effect, the entity is paying those taxes. And so instead of the individual getting the taxes, the credit for taxes paid to other state, North Carolina has said, we're going to give the entity that same tax credit. So the entity will pay taxes to North Carolina, will pay taxes to Virginia or to South Carolina, and will get a credit on the entity return for the taxes paid to other states. And so reduce the entity's North Carolina tax liability. In the end, the same amount of tax is going to be paid whether you do the PTET or not. North Carolina is going to get the same amount of money. The advantage of the PTET is that you're going to get this extra deduction on the federal return. So what Lori described as a possible windfall for Virginia entities is not going to exist for North Carolina, because North Carolina has this rule in place where you will get a credit for the taxes paid to other states. The way that that tax passes through to the individual North Carolina tax return is also different, and it's significantly different than it is in Maryland and Virginia. Because in North Carolina, you don't get a tax credit on your individual return. Instead, you get a deduction from your income. So let me make sure that we have that clear. Maryland and Virginia are going to pass through a tax credit to each owner. And then the owner will report their usual income on their individual return, calculate the tax due on that usual income, and then get a credit to reduce the tax in the amount of the tax that was paid on their behalf by the entity. Here in North Carolina, we'll start at the same place. We'll report the usual income on the individual tax return, but then we diverge. We then subtract the income that was already taxed at the entity level. And the tax calculated on the North Carolina return is calculated after the subtraction. So on a North Carolina return, you're never going to even see any tax from the business income anywhere on the tax return. And so where Virginia and Maryland are passing through a tax credit to their owners, North Carolina doesn't need to because the tax is never calculated in the first place. It just doesn't appear on the return because we've already subtracted out the income. So that's very significant. And across the country, there are now about 30 states that have PTET rules and PTET elections. About 2/3 of them are following the Virginia and Maryland example of doing tax credits to the owners. And about 1/3 of them are like North Carolina and doing the deduction from the income. So you're going to find both ways of doing it depending on which state you are filing tax returns in. The last bullet point on here is that non-resident owners are not required to file a non-resident return. So that's different from Maryland, where you do have to file one, even if you are participating in the PTET. That makes sense for North Carolina because, if you don't have any other North Carolina income, you're going to report your business income, then you're going to subtract your business income. That's going to come to zero. So North Carolina said, we don't need a return that's just going to tell us you have zero income in North Carolina. Don't bother us with it. If you do have other income besides the business income in North Carolina, then you do have to file a non-resident return. All right, next slide, please. All right, I included this same slide that Laura used for credits for taxes paid to other states because there are sort of big, bold rules in the North Carolina guidance that say North Carolina does not give individuals credits for taxes paid to other states. And it looks really scary, it looks really unfair, and I don't know why they emphasized it so much because it doesn't really matter. Because like I explained earlier, we on the North Carolina return don't calculate any tax on the business incomes. We don't need taxes. We don't need credits for taxes paid to other states. That is done completely at the entity level. That's who is getting the credit for taxes paid to the other states. At the individual level, we just don't need them. There could be a problem. There are some potential problems when a North Carolina resident owns a company and the company elects not to participate in North Carolina's PTET, but does elect to participate in other states' PTET rules. In that case, the North Carolina resident can't deduct the business income on their return since they didn't participate in the North Carolina PTET. And sometimes, not always, but sometimes they'll not get a credit for the taxes paid to the other states at the entity level. So if you pay a Virginia PTET, if the Virginia entity pays the PTET, the tax for the PTET, then a North Carolina resident may not be able to get a credit for it and also does not get the deduction for it because they didn't participate in North Carolina. It's an unusual situation, but it is going to crop up sometimes. If you are in that situation, please make sure that you're working very closely with your tax advisor to make sure that the company's elections are not causing you to pay taxes on the same income in two different states. Next slide, please. I believe this is a polling question coming up. Yes, it is. So tell me, I'm about to talk about some other state PTET regimes. For your own situation, are you the owner of a multi-state entity? And if so, in how many states do you file tax returns? 1 state only, 2 to 3 states, 5 to 8 states, or 8 or more states? I think the biggest client I work with files in about 35 states. So I would check 8 or more. Let's see how you all answer. All right, half of you are in 1 state only, and then the other half spread over either fairly small or 10% of you in 8 or more states, maybe some as large as 35 or 40. Okay, so next slide, please. I'm going to talk about just some highlights of other states that lie outside of the PBMares footprint. We have offices in Maryland, Virginia, and North Carolina. And in fact, as of this week, we have a brand new office in Wilmington, North Carolina. So if there are any of you on the call who are located in Wilmington, we now have an office local to you. We'd be very happy to start working with you if we're not already. Like I said before, about 30 states, so about 27 other states than our footprint states, have PTET elections, or in the case of Connecticut, a mandatory PTET. About half of the states are coming online for 2022. Now, every state has its own rules. There hasn't been a single standard law that all states have copied from each other and passed. Every state has set its own rules. That said, the same basic structure still applies to all states. The pass-through entity pays the tax at the entity level and deducts that tax as a business expense, thus it lowers its basic net income. The K-1 passes the reduced income through to the owners, and the owners thereby circumvent the 1040 SALT cap. The owners report the K-1 income on their individual state return and either, like in North Carolina, deduct the income already taxed, or like in Maryland and Virginia, receive a tax credit for the taxes already paid. That same basic structure exists in every state that is doing this. Next slide, please. I picked out 5 states to highlight just some of the quirks that exist out there in other states. These are all states that I myself personally have had some experience with, either filing or in some cases deciding not to file a PTET return in those states. If you are a resident of these states, or if you own a business that files taxes in these states, make sure that you're working with your tax advisor, whether it's us here at PBMares or your regular tax advisor, to make sure that you've followed all the rules correctly, because they can get complicated in various states. All right, next slide, please. Let's start with New York. The biggest quirk about New York is the timing, but also the method of the election. In New York, you have to make the election by March 15th of the tax year. That is, for 2022, you have to make it by March 15th, 2022. They actually did extend that to the fall, but the deadline for 2022 is already passed. You can't do it in New York for 2022 if you haven't already made the election. So you could do it for 2023, but you have to make the election by March 15th of 2023. And rather inconveniently, you have to do so by creating an account on the New York Department of Revenue website and making the election through this online account. And then when you go to file the taxes, you're also going to do that through your online business account with the state of New York. Not convenient, very difficult to say to your tax preparer, hey, go do this for me, because we don't have access to your online business account for the most part. So it's a highly inconvenient way of doing it, but is the way that New York has chosen to do it. New York does have an improvement over a state like North Carolina, insofar as the pass-through entity can elect to participate even if it has ineligible owners. So like North Carolina, individuals, trusts, and estates can participate, but if the entity has a partnership or a corporation as an owner, then it can still participate. It just excludes the ineligible owners from the calculations. All right, next slide, please. California also has a timing quirk, but it's a different timing quirk. In California, you only need to make the election on your normal tax return. So filing your 2022 return in 2023, you will make the election on that return that you're filing in 2023. However, in order for that election to be valid, you must make estimated payments by June 15th of the tax year. So if you didn't make payments by June 15th, 2022, you cannot elect for 2022. You have to get on board for 2023 and make sure you make estimated payments by 2023. There's another quirk I want to draw your attention to. The PTET rate in California is explicitly 9.3%. That is California's highest individual tax rate. California, like the federal government, has a graduated tax schedule, where you pay a higher rate if you are a higher income individual. The entity pays the highest rate no matter what, even if the individual owner is not in that 9.3% bracket. So the company may pay more taxes than the individual would. However, this may still be worth it since it means you'll get a bigger federal deduction than you would have if the SALT cap were not in place and you were paying the regular individual rate in California. So you might spend more money up front, but you might get a bigger benefit on the end, on the backside. The other thing to pay close attention to in California is that the tax credit the owner gets on their individual California return is non-refundable. Lori made a big deal about in Virginia that the credit is refundable. In California, it's non-refundable. That means if the credit is more than the amount of tax that is calculated on the return, you don't get a refund for it. You can only get a refund up to the amount of tax shown on the return. Instead, you get to carry it forward to the next year. But if you don't use it within 5 years, then you lose it. So if you're going to participate in California, make sure that you have enough income on your California return, or make sure that within 5 years you'll have enough income to use the tax credits that you're going to get. Next state is Massachusetts. Massachusetts opened up its pass-through entity tax to S corporations and partnerships, as did every other state, but they also let trusts participate. Trusts are in fact pass-through entities, even though we don't usually group them in with S corporations and partnerships, but they issue K-1s to their beneficiaries rather than their owners in similar ways that S corporations and partnerships do. So Massachusetts decided they are willing to include trusts as a pass-through entity eligible to elect into these rules. However, a quirk in Massachusetts is that owners get a credit for the tax paid at the entity level, but only 90% of the tax paid. For most states, they've arranged it so that they are making as much money as they would have made on the individual returns, that it's a wash for the state. It comes out to the same amount of money for the state. Massachusetts is skimming off the top a little bit here. They're saying, all right, so the entity is going to pay 100% of the tax the individual normally would, but we're going to keep 10% of that and not give the individual owner the full credit for the tax that the entity paid. So I can't explain why, but that's how Massachusetts is working. Louisiana is a state that I've filed several PTET tax returns in. In some ways, it's very easy. There is a separate filing that you have to make by April 15th of the filing year, so the year after the tax year. It's very, very simple form. You just fill it out and the owners sign it and you send it in. It can create a timing issue because, at least in my experience, it has been taking the state about 2 months to approve those elections that are sent in separately. So you sometimes can get the tax return filed before the election is approved, and you have to work with the state to make sure that everything is understood and working correctly. The other quirk of Louisiana is that they have said that their pass-through entity is agreeing to be taxed like a C corporation, not an S corporation that is a pass-through entity, but a C corporation that's not a pass-through entity. In a way, that's very straightforward. It's just saying that you calculate the tax as if you're a corporation. However, it gets a little strange because as part of the tax return filing, you have to submit what they call a pro forma 1120. And 1120 is the federal form that a C corporation files. There's no clear definition in the Louisiana statute what a pro forma 1120 is. And in fact, I had a situation last year where I was on the phone with an agent from the Louisiana Department of Revenue and getting exasperated because he couldn't tell me what exactly they needed me to send them because it wasn't defined in the statute. And so I didn't know what to send them. And we finally agreed to something that he said, all right, I can live with that. But it took some back and forth discussion to get exactly a clear answer. So that these things can be exasperating, but also I want to use this as an opportunity to ask you to have some patience with your tax advisors and with state officials even. You know, these state officials are trying to implement laws that were often written very hastily. And our experience has been that eventually these things do all get worked out. Like Sam was talking about Maryland, you know, it took them some time to get the forms all correct, but they did eventually get it correct. And it just takes some patience. We're all working toward a good goal here, and we will get there. Last state I want to highlight is Colorado. And Colorado may require the greatest amount of patience. They were originally straightforward. They passed a law in 2021 saying PTET would start in 22, and it's going to be a lot like North Carolina. You'd be able to deduct your income. Everything looked fine. And then they changed their minds about how they wanted to do it. And they went back and they amended their PTET law. As far as I know, Colorado is the only state that has already amended its PTET law. And they decided to make it retroactive. And they made it retroactive all the way back to 2018, which was when the federal SALT cap took effect. So Colorado residents or Colorado businesses that file taxes, or businesses that file taxes in Colorado, are going to be able to go back and amend returns for 2018, 2019, 2020, and 2021, all to elect into PTET rules. And then they'll be able to file federal amended returns for 2018, 2019, 2020, and 2021 to take the extra deductions that they're now entitled to and get refunds of federal taxes. Great news. However, you can't do it yet. Don't go filing any amended returns yet. Don't go calling up your tax advisor saying, you need to file 2018 returns for me in Colorado. We can't do it yet. The law specifically says that you can do it between September 1st, 2023 and July 1st, 2024. So wait 9 months, then start calling us and say, I want to file retroactive returns in Colorado. And hopefully by then, Colorado will have told us how to do it, because they haven't yet. But they will, and like I said before, these things do require patience with state officials, and please with us, your tax advisors too. So thank you for having patience with us. Thank you for listening. And I'm going to punt it back to Lori, who's going to talk about some tax planning opportunities.
Thank you, John. And yes, patience is definitely necessary with this because, well, as you can see, there are a number of nuances. Okay, so before we go charging into it, we do want to take a few things into consideration. Are the owners going to benefit from the PTET election? And what we see is generally states have developed laws that have internal alignment, you know, within the state, because the mindset at the point that the laws were being passed is, let's say, entity in Virginia with the owners into Virginia, living in Virginia, resident of Virginia. How does all of this work? And then when it comes to multi-state transactions, and I think I have a return that files in 38 states, John, and then several 30 states. But when you start getting into the multi-state aspect, it can get really interesting. So we want to think about, you know, is there going to be ability to get credit for the tax paid or deduction for the tax paid? If that's not available to the owner, then it's not worth doing it because you're going to pay tax twice. If there are differences in income that's taxed to the PTET and the allocation to the owners, and then what ends up in the 1040, if that starts getting weird, can we resolve it satisfactorily? And then one thing that we want to take into account, because we respect your dollar when it comes to our fees, it probably doesn't make sense to go file a lot of returns just to get like a $10 credit or a $20 credit or something like that. I think you might agree. So we also want to keep cost effectiveness in mind of making these elections. One of the benefits, obviously, to consider, if the entity has no taxable income, there's not going to be anything to be taxed. There's no benefit. But some of the interesting things that we're finding is that even if an owner might have losses from other activities coming through in the 1040, and then they've got a pass-through entity that has a lot of tax or can have tax, that there could still be benefit because the entity is going to get some benefit from their tax deduction. There will be less income coming through in the K1. That could have positive effect with other things swirling around in the return, particularly like if it might be net operating losses, it's going to slow the burn on those. So again, it's stepping back and looking at what are the nuances, what's going on. And it may not be all, oh, gee, no tax, no benefit. Maybe there is some benefit. So it's worth taking a look at. Let's go to the next slide. All right. So we've heard a lot of things, and particularly with Virginia and North Carolina, where it's limited as to the entities that can participate. There are some things that can be done, maybe not for 2022, but looking toward 2023 and beyond. Single member LLCs. Notice we're not talking anything about Schedule C, Schedule E, or Schedule F filers. They're kind of where they're at. But for somebody filing a Schedule C, would it make sense to elect S corporation treatment? Now you can participate in PTET. Now you can take benefit of the state tax deduction. Or in the situation of somebody where it's not appropriate to elect S corp, because that can bring a whole bunch of other tax complexities. Maybe forming a partnership by adding a spouse or a family member or doing something in that regard. Would it work? Multi-level partnerships. Could some of those tiered partnerships be eliminated such that now the entity is owned entirely by individuals? Does that make sense? You know, can you get the benefit? I know I have a couple of clients that, you know, a couple of them get together and they're doing these things in these partnerships. But when you step back, it's like, why really does that partnership has to be there for this particular investment or for this particular activity? But in doing this, we need to consider, and our clients need to consider all angles of what's going on before making changes. I mean, really try to be devil's advocate with yourself. Absolutely confer with legal counsel as appropriate. As Sam was mentioning with the Maryland, he works on a lot of very complex partnerships with hundreds of owners and multiple tiers. And so the drafting of the operating agreement has certain purposes and objectives in mind. So you need to keep that in account and in consideration when you're looking at what to do. And most of these PTET regimes are set to expire in 2026. That coincides with the end of the SALT cap or the Tax Cuts and Jobs Act provision. But I expect that if SALT cap continues forward and there's conversation regarding that and other provisions in the Tax Cuts and Jobs Act, that these PTET provisions will also go forward. But that is something to be aware of. So that's all that we have to provide to you at this point with regard to PTET. We do have another polling question. And as we're through with the polling question, we'll be able to take some of your questions. So, do you think your company owners will benefit from PTET? Please select something, and I've not put any snarky answers into this one. Yes, maybe, not sure, need to know more. All options are viable. And while that is happening, I'm going to address a couple of questions that came through ahead of our presentation today from people that registered. Virginia, estimated payments, that would be Form 502V. 502V, it is available on the Virginia website, and Virginia has issued guidelines. They dropped on October 31st, also on Virginia's website. Another question here, can the entity purchase tax credits to offset the PTET? And I'm assuming this may be a Virginia question, but we don't have enough clear information to make a recommendation. Our concern would be the impact on the credit coming through to the individual return. We do have clients purchasing at the individual level, but then I'll also add, at the moment, there aren't any available. All right, we have answers from our survey here, from our polling question. Most of you will be able to take benefit of the PTET. A lot of you are thinking maybe, and a fewer of you are like doubt it, or you want to know more. So good responses. We're eager to talk to you. Reach out to your tax advisor, and we'll do more. A couple more questions here. Are there income limits? John, Sam, I'm not aware of any states that have applied any kind of income limits to these. Are you aware?
No, not a single one.
Yeah, there's no income limit for Maryland.
Okay. Somebody asked a question about template footnote language. Not clear on what this is. I'd say it's best discussed with your PBMares practitioner. Does the SALT cap include individual taxes paid to a U.S. or foreign government? No, it does not. It's only state taxes that fall into what's calculated, state and local taxes into that SALT cap. Foreign taxes are handled separately, and for, foreign government and what have you, it's handled separately. Owners and natural purposes, I think we discussed that. If there are still questions, get with your tax practitioner. A requirement that owners are natural persons. And then discussion on capital gains. We are discussing that internally. That is a perfect example of something that does not apply at the state level, but absolutely at the federal. And so no clarity as to what should be done, but we're going to be discussing that. So I encourage you to reach out to your practitioner, and we're working on it. We're working on it. And absolutely no definitions provided by any of the states or the feds, and that's a federal issue. If a corporation does not sign up for PTET, is there any effect on claiming tax credit? And this particular one relates to New York State. I would say reach out to your tax practitioner, but depending on the state you're residing in, yes, you may be able to or should be able to take credit for PTET paid into other states where you're filing non-resident returns, regardless of whether you have a local PTET. But again, this is something to be discussed and worked through with your practitioner. Are there any other questions?
Hey, Lori, Susan here. I have a few. We'll try and get through a couple more. Does PTET apply to all income, including rental and investment from a partnership or S Corp?
Yes.
Okay, very succinct. Can I deduct taxes paid to other countries in Virginia PTET?
No.
Okay. Looking through.
I would say I would clarify that foreign tax one. Tomorrow,
Okay.
What's the nature or what's driving that foreign tax?
Okay, cool.
But no, you would not, generally not. It's foreign taxes are addressed through credits and exclusions and things like that. And with that, I would refer you to your practitioner or Lynn Eller, our PBMares international tax expert.
Okay. When calculating the tax, do you take into consideration the separately stated items such as Section 179 and interest, capital gains, etc.?
Generally, yes. John or Sam, have you guys seen any variances to that?
North Carolina is a variance to that. North Carolina specifically says you do not take into account separately stated items, but North Carolina also says that you do take into account differences between federal and state tax rules, such as Section 179. So it's all going to work out in the end that the income at the entity level should equal the income deducted at the individual level, but there could be some quirks in there that you need to pay careful attention to.
these are some of the nuances that we really can't get our arms around until we see actual forms and instructions.
Thanks, Lori and John. I think that's all of the questions we have time for today. For those of you that submitted questions that were not answered, one of our presenters will follow up with you. And there were quite a few questions submitted, actually. So it's obviously a hot topic and a very complex one at that. Thank you for joining us today. We hope you found our presentation useful and informative. Please do not hesitate to reach out with additional questions related to your specific situation. At the conclusion of the webinar, you will receive a brief 3-question survey, and we ask that you take a few minutes to complete it. The responses will help us develop future webinars. And to stay up to date on future events, please visit www.pbmares.com. Thank you again for attending, and have a great afternoon.